All right, let's talk about Asbury Automotive Group. And look, this isn't just about a company that sells cars. We're talking about a company that is building an absolute empire. From an investor's point of view, this story is a wild one. It's all about rapid transformation, some really high-stakes acquisitions, and a massive bet on the luxury market.
So how does that even happen? How does a regular car dealer become a giant on Wall Street? Because, that's really the central question here. Asbury is playing a high-stakes game of consolidation, totally transforming its entire business in just a couple of years. We're going to break down their strategy, the risks involved, and what it all means for its stock price.
Okay, first things first. To really understand Asbury, you have to look past all those shiny cars on the showroom floor. The real money, the engine that actually drives this whole enterprise, well, it's found somewhere else entirely.
Now look at this chart. It completely flips what you probably think about car dealerships on its head. See the gross profit mix? Selling new and used cars is actually the smallest piece of the pie. It's kind of crazy, right? The vast majority of profit comes from the service bay and the financing office. Selling the car gets the customer in the door, but servicing that car for life, that's what truly pays the bills.
And this brings us to a super important term in this business, fixed operations. It's just the industry lingo for the parts and service department. But here's why it's so critical. You see, vehicle sales can swing wildly with the economy. It's a real roller coaster. But fixed operations are remarkably stable. I mean, cars always need oil changes, new tires, and repairs, right? This predictable, high-margin business is the absolute foundation of Asbury's financial stability.
And this number shows the true power of that foundation. Asbury's fixed absorption rate is over 100%. So what on earth does that mean? It means the gross profit from just parts and service is enough to cover all of the dealership's fixed costs. We're talking rent, utilities, salaries, everything. So every single dollar of profit from selling a car or from financing drops straight to the bottom line. It's an incredibly powerful business model.
So with that incredible profit engine in mind, let's see how Asbury is turbocharging its strategy. They've gone on an aggressive shopping spree, and it's not just about getting bigger, it's about fundamentally changing the kind of business they're in.
In an incredibly short amount of time, Asbury pulled off two of the largest deals in auto retail history. First, bam! They bought Jim Koons in late 2023, a huge player in the Mid-Atlantic. Then, just over a year later, they made an even bigger move, acquiring the legendary Herb Chambers companies, which gives them a dominant position in New England. We're talking about adding billions in revenue, practically overnight.
But again, this wasn't just about getting bigger, it was about getting more premium. This whole strategy was designed to deliberately rebalance their entire portfolio. Before, their focus was a little less clear. But now, after these deals, their revenue mix is heavily weighted towards luxury and high-end import brands.
And here's the why. This whole pivot to luxury is a calculated, defensive move. And it's pretty smart. Think about it. Luxury cars are more complex, their parts are more expensive, and their owners are way more likely to take them back to the dealership for service. By loading up on premium brands, Asbury is making a strategic bet on securing a more profitable, more predictable stream of service revenue for years and years to come.
Of course, when you have a strategy this aggressive, it's going to have a major impact on the company's financials. So let's pop the hood and see what the numbers are telling us. First off, the strategy is delivering just explosive top-line growth. A 19% compound annual growth rate is massive. It really shows how combining their regular organic growth with these huge acquisitions is rapidly expanding the company's size and market presence.
And at the same time, that core profit engine we keep talking about, it's still humming along. Even if you strip out the new dealerships they just bought and only look at their existing stores, that all-important parts and service business still grew by a healthy 7%. This proves the underlying business is solid, and they're not just buying growth.
However, it is not all smooth sailing. The company is facing the same headwinds as the rest of the industry, especially in the used car market. Higher interest rates make car loans more expensive, and that puts a damper on demand, which is why their used vehicle revenue actually dropped. It's a cyclical pressure point they just have to manage.
And here's the cost of all that rapid expansion. To fund these massive deals, Asbury took on a significant amount of debt. This number, their net leverage ratio, jumped to nearly 2.5 times their earnings. Now, for an investor, that's a key risk indicator. It's a flashing light, and it's above the company's own target range.
Because of that, management has been crystal clear. The shopping spree is over, for now. They've said that the #1 priority for the next year, maybe year and a half, is to use their strong cash flow to pay down that debt and get that leverage ratio back to a more comfortable level.
Now, as if integrating a multi-billion-dollar acquisition wasn't hard enough, Asbury is simultaneously performing what its own CEO calls a heart transplant. They are replacing the core software system, the digital nervous system that runs every single aspect of their dealerships. Trying to do both of these massive, complex projects at the exact same time, well, that creates a period of seriously high execution risk.
So, let's put it all together. How should an investor think about Asbury today? It really comes down to a classic debate, the bull case versus the bear case.
Okay, the bull case is pretty compelling. The argument is that management has successfully transformed the company, shifting it toward that more stable, higher-margin luxury segment. They've got a great track record, and the bet is that they can integrate these new businesses, pay down the debt, and unlock a ton of value. On the other hand, the bear case focuses squarely on the risks. That high debt load makes the company really vulnerable to an economic downturn. And doing a massive acquisition and a core IT overhaul at the same time, that's just fraught with peril. All of this is happening as we're seeing some softening in consumer demand.
And that risk, it definitely seems to be priced into the stock. This table shows that Asbury trades at a notable discount to its peers. So the question for an investor is pretty simple. Is that discount a fair price for all the risks they're taking on? Or is it a rare opportunity to buy a best-in-class company while it's in the middle of this huge transformation? And that leaves us with this final thought. Asbury has made a bold choice. They're building a premium empire funded by a mountain of debt. The entire investment thesis rests on one core belief, that its bedrock service business is strong enough to carry it through all the integration risks and any economic turbulence that's ahead. Whether that bet pays off, well, that's going to be the defining story for Asbury in the years to come.